Back in 2017, I published this article to the blog, Trading Leveraged ETFs for Max Profit, which was an article that explored what leveraged ETFs are, how they're constructed, the risks involved in trading them, and how to make money trading them. I also published a video version, which has received hundreds of comments. To this day, we still receive comments, questions, and feedback from this lesson. Most recently, 4 weeks ago, a comment came through saying, I still haven't seen any good reasons not to hold leveraged ETFs long term. So in this video, I want to give you 2 concrete reasons why leveraged ETFs do not belong in a set it and forget it investment portfolio. Stick around. Welcome back to Trade Risks YouTube channel. I am your host, Evan Medeiros. Thank you so much for joining us. If you're new to this channel, welcome. We have lots of educational videos just like this sprinkled across the channel. We've got interviews with other traders, and we have our long-running market analysis series. Every Friday it goes out, it gets published. So check us out, subscribe to the channel so you can stay up to date with all of that wonderful content. Now, let's circle to today's lesson. I'm very excited and eager to get into it. What I want to say before we jump into this, I'm going to try and keep this as quick and actionable and to the point as possible. If you missed our first video, if you're wondering what the heck a leveraged ETF is or what goes into them, how they're constructed, that's all part 1. We're not going to talk about anything in this video about that part of it. We're going to assume you know what leveraged ETFs are and that you're probably trading them right now. All right, so let's jump right in to risk number 1. This is what I'm referring to as diminishing returns, the risk of diminishing returns. It is the less severe of the 2 risks we're going to be talking about today. This is more commonly called volatility decay or tracking error. This is effectively the cost of borrowing, the cost of repricing, the ebbs and flows of up and down and bear markets and pullbacks and bounces and falls. This is what the ETF is trying to keep pace with, all right? And we're going to use the TQQQ throughout this video as our example. And I've got a slide here, a screenshot from their prospectus. So this is from the TQQQ summary prospectus, and they have a section in there called holding period risk. And I'm going to read to you just this yellow highlighted. The performance of the fund for periods longer than a single day will likely differ from the daily target. All right. The daily target is, in this case, a 3x return, a 3x multiplier on the underlying ETF that it's tracking, in this case, the NASDAQ 100. So if you were to buy the TQQ at 9:30 in the morning and sell it right before the close at 3:59 p.m. Eastern, you're likely to get a pretty darn close 3x performance result relative to the QQQ. When you start to hold overnight and you start to go longer, this is where you run the risks of diminishing returns. Diminishing returns aren't guaranteed. It will depend primarily on the path the leveraged ETF takes and your timing in the trade. Let's go to some charts, okay? I'm going to show a little chart here of recent trading or recent history, and then we're going to look at a longer term outlook. QQQ on the left, TQQ on the right, 1x on the left, 3x on the right. This goes back to the start of 2021. On my chart on the left-hand side, you can see 2021. It's a weekly chart. On the right-hand side, you can see the start on the left is 2021. Take a look at these 2 charts. You can see that one is up here in the very upper right. This would be called all-time highs. I'd have to zoom out further, but it's all-time highs for the QQQ at the time of recording this, June 20th, 2024. And if we take a look here at the TQQ, you can see that this is not all-time highs. This is in fact in a drawdown. So let's take another quick look here at QQQ. It is approximately, I'm just going to round here, 17.5, call it 18% above its 2021 highs. Let's take a look at the TQQ, 17, call it pretty much 18% in drawdown below the 2021 peak. So this is pretty different here. okay, from this snapshot, from this 2-year period, from the start, call it, of 2022 to where we are now, it's basically 2.5 years. The QQQ, the 1x return, if you held that, let's just say you bought the peak. Let's say you were a terrible market timer, right? We've all been there. We've all bought the top. I've done it countless times and I know I'll do it again. But let's say we bought the top here in QQQ back at the very November highs of 2021, and we have been sitting with this position for 2.5 years. We would be up approximately 20% after a rough drawdown throughout 2022, but we would be up 21% buy and hold prevailing in the NASDAQ 100 if we had bought the peak here at 2021 highs, TQQ, right? Thinking, I love the Qs, I want to own it at a 300% rate. Well, guess what? 2.5 years later, you're down 18%. In other words, you're down 18% from the prior highs. If you had bought the Qs instead, you'd be up 18%. So that delta is pretty significant. So in the last 2.5 years, which is not a short amount of time, this is a long, painful period that you would be in and scratching your head, a drawdown relative to the underlying benchmark that you're trading. So this here is already just a micro example of a 2.5 year period, which I would not call short term, of the deviation that you can see when you're trading leveraged ETFs. Now, let's say you are a great market timer. Let's say you're really good at market timing. From the 2023 lows, right? Let's just take it from essentially the January start of 2023, these lows right here. If you were to market time and buy the bottom in the QQQ, you would be up approximately 84% in the last year and a half, all right? Amazing return. Let's take a look at the TQQ from the 2023 lows to where it is right now. You are up 366% in a year and a half. So even greater than, that's above, back of the envelope math, that's above a 3x return, right? So that was fantastic. The difference was you had to be a good market timer. You had to avoid and not sit through this brutal bear market of 2022. Timing does matter. Timing and time. You're paying an expense ratio, and you're also suffering the volatility, decay, and the, cost of borrowing essentially to maintain that 3x target from the fund. Now, I want to take this one step further here and take a quick look at Portfolio Visualizer just to kind of put a pin in this point, and then we'll move on to what I consider the more drastic sort of risk factor. This is portfoliovisualizer.com, great website, and I've got in here essentially the TQQ plotted versus the QQQ. This looks at the last 10 years of data. So we're not going back to inception, but we're going back to June 2014 to May 2024. And we're looking at the results here. You can see them plotted right down here. You can see the annualized return, but I'm just going to cut right to the chase and say, what was the compound annual growth rate comparison? So that is the TQQ, 36.59% over this 10-year span. Let's take a look at the QQQ, 18.27. All right. So let's pull out our handy dandy calculator. 18.27 times 3. Naively, we would have expected a 3x return to be somewhere in the ballpark of 54.8%. You can see that once again, the annualized was now at 36.59%. So that's more in line with a 2x return. Over the last 10 years, holding the TQQ got you effectively a 2x return. Now, you might say to yourself at this point, Evan, hey, I'll take a 2x return. I don't care. QQQ is one of the best performing stock markets assets in the world over the past decade. I'll gladly take a 2x return. Okay, reasonable. Here is the problem. We are looking at a 10-year time slice, and we have seen that our target of 3x has diminished down to 2x in a 10-year holding period. For folks who anticipate of a buy and hold, set it and forget it, this is my retirement account, or I'm going to plan on holding this for 30 years because the NASDAQ is great and I want 3x greatness. I would argue that over a 20 or 30 year time horizon, the diminishing returns would continue. And if you were to hold the QQQ and the TQQ in a portfolio for the next 30 years, I would guess that the QQQ would have more value after that 30-year period. And I'm assuming that the Qs grew in value. Hell, they could even grow at a 10% growth rate for the next 30 years. I bet you that the QQQ would have more value than the TQQ. And that is because all of the time span of volatility, ebbs and flows, the cost to borrow, maintaining leverage, everything in between is eating away with the expense ratios over time in your TQQ leveraged ETF. So I think for a very long time horizon, it does not make sense. I like to almost think of leveraged ETFs like a long option contract, right? When you trade options, when you're buying options, there are two dimensions that you have to nail. You have to nail the direction, but you also have to nail the timing, right? Yes, there's some implied volatility business you need to be cognizant of too. But honestly, if you get the direction right and the duration right, or the magnitude right, then that sort of solves everything else. So leveraged ETFs, I consider to be in very similar situation. There's no specific strike price that you're paying for or having to purchase, but you do need to be cognizant of it because it is going to amplify returns, just like that example where we looked at the TQQ and the QQQ off of the 2023 lows. If you were able to nail those, relative area, obviously, you don't have to be exact down to the penny, but if you were essentially being a buyer anywhere in, this range for the TQQ versus up here in this range, you're going to be a heck of a lot happier, right? If your timing is a little more on point, actionable, and following the market, then you are setting yourself up for a better result. So back to the timing, the strategy, right? Part one, we talked about some other strategies that you may want to think about if you are trading these, but hopefully that makes sense. This is before we get into the more severe risk, which we're about to outline here, which I don't think many people think about or talk about or acknowledge. And that's the more scary one, which we're about to walk into. Before we walk into that, right? And before, I'm making myself out look like a hater for leveraged ETFs. I trade leveraged ETFs almost every single day. In fact, I have held the TQQ for the entire year of 2024. I have been in the TQQ. It's been a portfolio position for going on 6 months, one of my longest holding periods for a leveraged ETF, but I've been holding it for 6 months. So I trade these and I use them, but I will not buy and hold it forever, right? There is going to be an exit point. It could be next week. It could be next month. It could be next year. But there is going to be a point where I'm going to exit this based on my strategy rules. I will not, hold this to eternity blindly and just forget about it, right? So I am a user. I think they have their place in a trading portfolio, a tactical portfolio. And we're going to talk about some benefits towards the end when we recap everything. But let's move on to risk factor number 2, which is the more severe and less talked about risk for these ETFs. The second critical error I'm labeling as just flat out risk of ruin, your investment going to zero. Okay, now let's go back to the good old prospectus here from the TQQ website. And I want to talk about this one first here. So again, this is a screenshot from their prospectus online. This is called, in their principles risk section, leverage risk. The fund uses leverage and will lose more money when the value of the index falls than a similar fund that does not use leverage. Okay, I think we all understand that leverage amplifies returns. The use of leverage increases the risk of a total loss of your investment. Okay, this makes sense. Again, if the index approaches a 33% loss at any point in the day, you could lose your entire investment. Now, I think you and I would both agree that a 33% decline for the QQQ is unlikely, right? Now, how unlikely is it? That is the question. Is it impossible? Is it impossible? Because that's what you're asking here. Is it impossible for the QQQ to decline 33%? I'd say the answer is no. We have seen all kinds of things in markets, right? We saw crude oil go negative a few years back. Negative, right? Negative for a commodity, for a barrel of crude oil, or 100 barrels, or I don't even know how many one futures contract controls. But we have seen some weird things in markets. So the question I would pose right now is, do you not think that there could be a flash crash that brings QQQ down intraday for a split second, down 33%? Now, of course, look, we have circuit breakers. I understand that we have lots of things in plumbing that should happen, right, when they should happen. But we know markets like to test the edges. We know weird things happen. God forbid there is a sudden war, terrorist attack, or virus, or something that hits the market, blindsides it when no one is looking. There are potential plumbing issues here with these leveraged ETFs that I don't think many people are thinking about or want to think about. Now, here is another even more scary slide, in my opinion. This is from their prospectus again. This is under a section called Counterparty Risk. Here is the most important in yellow. The fund may lose money if a counterparty does not meet its contractual obligations with respect to swap agreements, if the index has a dramatic intraday move that causes a material decline in the fund's net assets. The terms of a swap agreement between the fund and its counterparty may permit the counterparty to immediately close out the transaction with the fund. In that event, the fund may be unable to enter into another swap agreement or invest in other derivatives to achieve its investment objective. So this is very vague here in terms of counterparty risk. It's saying that, look, there are agreements that are in place. There are contractual swaps and leveraged vehicles that are being purchased from either prime brokers and probably Goldman Sachs and JP, and they're probably some very big established banks, I'm sure. But if there is an issue with your counterparty, right, which again could be any number of dominoes or weird reasons, right? Bank failures, bank runs, some type of contagion that goes through the system. Again, we don't know. The point is not to be an alarmist or say that this is unusable, but there is this risk of ruin that is not zero. I don't know what the probabilities are. I would say that they are pretty low, right? We're not talking about a high percentage chance that we're going to see the Qs go down 33% in a day, or there's going to be some counterparty issues, but there is a chance. And once again, from a pure mathematical perspective here, the longer your time horizon, right, the greater the chance of risk of ruin. It is only a matter of time before some event would actually cascade and trigger this to happen, right? It is just a mathematical truism that you're sort of asymptotically going up to a probability of 1 of something happening like this given a long enough time scale, okay? Again, is it likely? I don't think it is. It might not happen in our lifetime. It might be 150 years from now, right? We don't know, but the point is there is a non-zero chance of this vague sort of language here of counterparty risk and dramatic intraday declines that puts a certain additional layer of risk going to zero onto the table, into the calculus here of position size, portfolio allocation, net worth, allocation. All of these things start to come into a question when you're trading or holding a Wall Street product, right? You are not holding a stock certificate that entitles you to future cash flows of Apple's stock. You are trading just a man-made derivatives product, which we have seen in the past completely blow up and experience termination events like the XIV volatility product a number of years ago. Different product, right? It's not an ETF. It's not the TQQ. It is something that is inherently more dangerous and makes sense on how it blew up. But it goes to show that it is possible for liquidations to happen in a snap of a finger overnight, like happened in the XIV or after hours, and that's it. Right? So again, I would assume it's a low probability, but it is a non-zero probability. And that, with your time horizon and your trading strategy and your position size, these all have to work together, you know, hand in hand. So back to this original question here of the YouTube question that came in the other day of, I have not seen any good reasons why not to hold this. I think these are two very valid, clear reasons why, if you plan to set it and forget, hold leveraged ETFs, you are setting yourself up for some disappointment, I think, because A, the diminishing returns that are very, very probable, or you have the more lower probability here of some type of termination event or a liquidation of the fund. Again, I don't think that that is probable, but it's certainly a real risk. I mean, the other thing that was not discussed at all is the behavioral side of this, right? When you go through a 70% drawdown, when you go through an 85% drawdown or a 3-year period of underperforming in TQQ versus QQQ, how are you feeling? Are you going to hit the exit button? Are you going to rotate out of the trade? Because that in itself is its own can of worms when you start to think about the potential drawdowns, leverage factor, and just straight up emotional toll that is going to take on someone to endure through that period. Okay, so there is lots to think about here. Let's circle it back again. I want to say that I do use leveraged ETFs every single day. I think they are fantastic. Or I shouldn't say every day. In my day-to-day routine, they are certainly in the arsenal, and I think they are efficient uses of capital. They are a great way to get exposure at the right times. You can make, you know, magnificent returns in short periods of time, and you can do it with the big ETFs of the market. I think that is fantastic, but there are, of course, risks. Nothing is free. Risk is always sort of transformed in financial markets, and sometimes it's very hidden. That is all I have for this video part 2 edition. If you have any questions, comments, please leave them below. Let me know your thoughts. Thank you so much for tuning in. Hopefully you enjoyed. Once again, we've got links in the description of this video. Get on our weekly newsletter, keeps you up to date with everything we are publishing as well. You can subscribe to our YouTube channel and check out some of the other links and resources we have in the description of this video. Thanks so much for tuning in. Take care and hope to see you in a future video.